most of these things that the market is still discovering were like addressed early on, and different facets of Bitcoin take on more meaning once something gets developed, like say Lightning, or when AI comes around, or when stablecoins are invented. These sort of things add new ways to think about Bitcoin or to use Bitcoin.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discuss about Bitcoin. Lyn Alden says, I believe particularly in the intermediary phrase, yes. I mean, when we think of Bitcoin, we think of something like this. Age-old questions such as what is Bitcoin, because each Bitcoin seems to reveal new characteristics of itself to us. Or at least, if you go back to the Bitcoin chat boards, most of these topics that the market is currently talking about are still there. Discovering was addressed early on, and many facts of Bitcoin gain on more significance once something is discovered. When new technologies, such as Lightning or AI or stable coins are developed, these kind of things bring fresh value, new ways to think about Bitcoin or to use Bitcoin. To put it simply, a blockchain is a decentralized database, and it just so happens that the blockchain money is the killer app for a decentralized database, because money is continuously looking for what is a ledger that we can all access. We might agree to use dollars since it's the most convenient. Right now, we know that the fiat currency of the most powerful country in the world will be all right for the next 6 months, dollars, and so we can deal with it. We might use gold because you both recognize that the money is a commodity that is very useful, and with a database, you can discover one quickly that's sufficiently decentralized and unchangeable. And you're thinking, wait a minute, this is practically money in a decentralized system. I can hold a unit of this or units of it, and I can either send it to anyone or recall my own words and move around the world, rebuilding my capacity to access it there. So there is that utility component. And lots of things Lyn Alden discuss, so please watch the video to end, and share, subscribe our channel Everyday Finance. Thanks.
I think especially in the intermediate term, yes. I mean, basically, when we think of Bitcoin, there's this age-old question, what is Bitcoin? Because it's Bitcoin keeps revealing new facets of itself to us, or at least if you go back at the Bitcoin talk forums, most of these things that the market is still discovering were addressed early on, and different facets of Bitcoin take on more meaning once something gets developed, like say Lightning, or when AI comes around, or when stablecoins are invented. These sort of things add new ways to think about Bitcoin or to use Bitcoin. The way I would describe it is basically what a blockchain is a decentralized database. And it just so happens that the killer app for a decentralized database is money, because money is constantly looking for what is a ledger we can all agree on. We might agree to use, dollars because it's the fiat currency of the most powerful country in the world right now. We know that over the course of the next 6 months, they're probably going to be fine dollars. And so we can use that workably enough. We might use gold because we both understand that it's the commodity that's best, kind of useful as money. And with a database, when you find one that's sufficiently decentralized and immutable, and you say, wait a second, this is basically money in a decentralized cloud. I can hold a unit of this or units of it, and I can either send it to anyone, or I could remember my words and travel around the world and reconstruct my ability to access it there. And so there is that utility aspect. And I think the vast majority of its long-term usage will be for money, just because money is such a big application and it's so suitable for it. But there are other things like data storage. People have put arbitrary data into the blockchain that they want to preserve there. It doesn't prove that it's true, but it proves that it's not tampered with from the point of insertion. And so it could be putting culturally relevant books in there. It could be timestamping other systems into it, whatever the case may be. I think that is a long-term use case that I expect it to be smaller than money. And then there's other things. You can use it as a network. You can use Lightning as a network to run around stablecoins, for example, in a way that is cheaper than Ethereum. That's a similar reason why Tron popped up, is because people wanted to use Tether more cheaply than they can use it on Ethereum. And so generally between Bitcoin and stablecoins on other networks, money's been by far the dominant staying power use case for this whole field of technology. And most other stuff becomes like a narrative, and then it's kind of fades away into either obscurity or at least a smaller market. Yeah. So money at the end of the day, when you look at some of the literature, basically like Mises or further back, it's the most saleable good, which means it's basically the most liquid good. Like what good could you bring with you as a bearer asset that you could find someone pretty quickly to take it off your hands at something close to the market price? Like if I have a fine bottle of wine that's worth like, I don't know, $300, if I just wanted to quickly dump that on the market somewhere, most people don't know how to evaluate wine. Most people don't even know. So it's a very specific type. And so I'd have to find someone and probably give it to them for like $100 or something like that, because I'd have to find someone who basically there'd be a lot of slippage in that transaction unless I happen to find this like right wine shop, right? So it's like unless there's certain areas where I could get full retail price or full price for it, but the ease of which I can do it is low because there's low liquidity, low fungibility, that kind of thing. So when you have a good money, you have one that's got plenty of liquidity, plenty of accessibility. And the fine line there is if you have a money that is not divisible enough or not fungible enough or is like hyper rare, like it's like, rhodium, for example. Most people don't have any, most people don't identify it. And so just because it's super rare doesn't mean it actually gets monetized. And so it's kind of a weird accident of history that the things that get monetized are things that are quite rare, but that they're already widely held. And so those tend to be things that are hard to make, but that they're long lasting once they're made. And so we build up pretty significant stockpiles. And, that's where, for example, Safety popularized the idea of the stock to flow ratio, which is different than the stock to flow model. That's different than saying you can predict the price of Bitcoin based on it. But it is saying that for a money, generally, instead of looking at extreme scarcity like rhodium or meteorites, things like that will, they're so rare they have liquidity and fungibility and divisibility problems. And instead it's saying what elements or what commodities or what types of money are hard enough to make that even though there's quite a bit of it, we're very, and most people have some or easily recognize it, but that also you can't really make more of, because if you can make a lot more of it, then everybody has a disincentive to want to hold much of it. That's why we don't use salt as money anymore, for example, whereas we do still in some ways use gold as at least as a store of value type of money. And so it's really about that concept of a lot has been made, but it's hard to make more. Yeah, generally as you move up the commodity chain, usually the commodities with the higher stock to flow ratio, because it's almost synonymous with that liquidity, because it's not hyper rare, it's widespread, but then once it's gotten to that widespread stage, it's hard to further dilute. And so that would be shells, like complex shell ornaments, for example, in a hunter-gatherer environment, they're challenging to make even though they're fairly common. And the same thing would be true for, say, gold and silver in later eras. We kind of steadily moved up from using things like grains as money, which have a low stock to flow ratio, to moving towards things like gold that have a very high stock to flow ratio. Yeah, so gold, it's interesting because gold was the best money, but it was still imperfect. And that applies to silver as well. So they're imperfect in the sense that it's not super easy to verify the fineness of gold or the amount of gold unless you want to weigh it with every transaction. And so there are various technological layers employed on top of gold to try to make it even more effective at being money than, say, raw gold would be. And coinage or coin-like objects were among the earliest one. So you'd blend the natural properties of gold with some sort of recognizable authority, like a kingdom or an empire, that says not only is this gold, this is a specific amount of gold, and we're going to add like a face of an emperor on it, and we're going to put ridges around it so it's hard to reduce the amount of physical gold. As long as it looks visibly intact, you're getting most of the gold that's supposed to be there. And you can generally trust the purity based on the reputation of the empire, which over time gets abused. But basically what they would do is they would use their technology to make that gold even better money. And so a gold coin would have basically three layers of value. So one would be the underlying gold itself. Two would be the coinage premium, that it's basically been put into a verifiable, measurable shape and someone's done that work for us, which is convenient. And even today, with the technology we have, like American Gold Eagle coin will generally sell more per ounce than, say, a 400-ounce gold bar, because that additional kind of like layer of, acceptability and verification is useful. And then the third layer would be legal tender. So if you had an empire with certain gold or silver coins, these were kind of mandated or expected to be accepted everywhere in that area, and you have foreign gold or silver coins of a similar size, they'd still be recognized as money and they'd still be useful, but they'd be less liquid, less recognizable, and less accepted than the domestic currency. And so they'd often trade at a slight discount when they're outside of their own jurisdiction, because it's just like it's a foreign object. It might be a slightly different size, and therefore it doesn't easily fit into our calculations. It's less easy to prove that it's the real thing, and so you'd have that third layer of value. And the problem was that these layers of value would give kings the opportunity to debase their coins. So the unit of account would be somewhat abstracted from the sheer amount of gold or silver in the coin, and so a king could say, okay, well, we're going to tax all these coins, and then we're going to melt them down, and we're going to change them from, say, 90% gold to 70% gold, so we can spend more gold back into the economy without raising anyone's taxes. And that works for a while because, one, at first you wouldn't even necessarily tell the difference between a 70% gold and 90% gold, and two, when it's still stamped with the same unit and the king saying this is the same unit, it takes time for that greater supply of money to kind of force up prices. The initial people that get that will still treat it the same way. And so gradual debasement became a common occurrence throughout pretty much every culture that ever had coinage. And it's because of those layers of extraction between the fundamental value and the market value.